Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyceno with Kevin Casey, and today we are joined by none other than Louise Wood. Woods.
Louise
Sorry.
Woods,
Oh God, how do you screw up the easiest name on the face of the earth? I
right?
got the F.
Happens all the time.
Oh my gosh, I wrote it today and three times, and I'm like, I know it's Woods, but here we are. So, good morning, everyone. We're coming to you, all of us, from the California Association of Mortgage Professionals Summer Conference, and we are having fun. Yeah,
Yes,
Yeah,
definitely.
good event.
we were just talking about how the three of us, we didn't realize, or I didn't realize that the three of us are the new president of CAMP's advisors, and we love Louise, so that makes us happy because we'll have a unified message for him, right?
Yes,
Well, what
absolutely.
oh, I don't know about you.
The common denominator is that we've all been in the business for 675 years. So it's yeah, it'll be good. There's a good energy. That's what I'm enjoying about these last couple of days. Really good energy. We heard from Chica Sunquist, who's the California DRE commissioner this morning. And for her, it sounded very positive. Is that your takeaway, you guys, from what she was saying?
Yeah, absolutely. I mean, they're looking for, growth, right? And they want, licensees to either renew their licenses or come back to being licensed. We did lose a lot of people. And so she was talking a little bit about that, right? And just that they're here to support us and, let's do some good business. So that was kind of the overall message that I heard.
That's one of the things I love about the DRE is they're really all about just protecting the consumer and working with an LO or a real estate agent who is also trying to do the right thing. They're not out to get everyone. The numbers I saw in the conversations I've had with her were that our numbers have there was a spike during COVID of people getting into the industry, obviously because the volumes were higher. But what they've seen is a return to normal. And in my conversations with Chica offline and also confirming this with the DFPI, the number of renewals has stayed very consistent. And that was her slide this morning. And so that's, all of this talk about how there's been this monster exodus from the industry. That's not true. The people who got in just to make a quick buck when things were easy and they were cherry picking, those people are gone, as always. They always will be, they always have been. But the people who are tried and true, those levels have remained consistent other than that spike during COVID is what.
Wouldn't it stop the ones that just come in for the quick buck from coming in the first place?
Amen. I have been saying that. I mean, we are professionals. We need a profession full of professionals. Can you imagine if an attorney could go, you know what? There's this huge murder trial. I could make so much money. Let me just go handle that. And then I'm out. I'm going to go back and work as a greeter at Walmart or whatever they do. So anyway, I'm a huge fan of raising the
I
bar,
think more than greeters at Walmart. I think they actually are checkers.
whatever, whatever. So my point is we need to raise the bar. And actually back to an offline conversation with Chica, I mean, she is much nicer about, I'm sure we can just educate people to do the right thing. I'm like, listen, some of the
Yeah.
slime buckets are just slime buckets and they need to get out. I'm just over it. Like, let's not sugarcoat it. Let's not just, like tiptoe around it. No. If you are a opportunist slime ball, I don't want you in our industry. I don't. I don't want to educate you. I just want to boot your to the curb. All right, moving right along.
Audrey kind of went a little bit off on that one, right?
Is
You're not wrong.
it is an issue, I think, in our industry. It's a huge problem. A lot of our problems within the industry and for the consumer are that we just let any old person come in and go, I can do a loan. So they present a one size fits all. They don't know anything about anything. They have no experience. They've not had a mentor who's worked with them to help share the experience they have. And we need new people, no doubt about it. But we don't
Yep.
need opportunists. We need people who choose this as a profession. And okay, now I'm going to stop talking about that. Um, yeah, but it is annoying. That's to put it mildly. Okay, there are a couple of interesting things. So there's a few pieces of legislation that have happened or are happening in California, and one of them that is most concerning is AB 130, which, well, and I think it's passed. I need to check the status of this because I'm not entirely sure of that. But basically, it makes it next to impossible to foreclose on someone with a second mortgage, which could really kill our HELOC and second mortgage business in this state. What are your thoughts, Kevin? I know that
Take
I know ARC doesn't do second, so I'm not gonna hold Louise's feet to the fire on this.
there goes our second business. And right now, seconds have been really great for me because when I do the math, no one wants to give up that 2%, 3% loan they have. But when I sit down, I go, listen, you're borrowing $150,000 on a second, and you only owe $300,000 on your first. You're better off getting a new second. I know the rate's 6.5 or 6.8 or 6.9, but you're going to be paying 10% on that second. And when I do the math, you're paying less by just doing one loan altogether. And then, but if they lose a second altogether, then who knows, that might just come into play also. But yeah, I see that being a big problem. I don't see it as serves a consumer to make it so, oh wait, now we can't get a loan.
Yeah, now it's not even an option because who wants to lend money to someone that they don't have any assurance that they can get it back?
Yeah.
So, and as always, it's a math problem. It's a math problem and an analysis of their overall situation, financial situation, what they have going today, and what their future is going to look like. So there is nothing that says, I hear people all the time who don't do loans anymore, by the way, and they're like, oh, well, you should never give up your first. You should always just do a second. That's the best way. No, 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 no. You have to really look at each individual situation. That's what makes us stand apart from someone who's an order taker or
Right.
working in a call center. So I just think it is a mistake again. Although
You have to be your mortgage professional, right? You need a true mortgage professional that can walk through your needs, what you need specific to your lifestyle, your income, your housing situation, right? Whether it be a second or refinancing the whole thing. But yep.
all right, so we have a little note here from Mr. Chrisman who says that Newsom signed AB 130 on June 30th. So that is law, and it will be very interesting to see what happens with the market.
Yeah, so I haven't heard anything from the lending side.
What?
I haven't heard anything from lenders saying they're going to stop doing seconds.
Well, it just happened on June 30th, and $10 says most of them don't have a clue yet.
A second, it just makes it very tricky to foreclose. Basically, the law states that if you've committed any violation, you cannot foreclose. And
Right.
so
Oh, sorry, go ahead.
it's very difficult not to complete a violation when you're doing a loan these days for some reason. I don't know why that is, but
Well, and the idea that you're going to have to prove that you didn't do it. So, and there's some form like now you have to file something or do something that says, I have not committed any violations even before you can start the process. So again, I know just enough about this to be dangerous, but not enough of it about it to be credible. So
I think yeah,
the
I think we're not going to see any changes until the first few cases where people don't go into foreclosures and then aren't able to are able to stop the foreclosure. And when the bank takes the loss, suddenly the bank will say, okay, now we're going to stop doing these loans, or whoever the investor is. But I don't see them being so proactive that they're going to stop doing seconds now.
I disagree because I see that lenders see a guideline coming down the road and they see it as a warning sign and they want to get in front of it and protect their tails and their money. So I
Well,
don't think it will make all the seconds go away, but I would imagine there are going to be some safeguards or something's going to happen. I don't know. We'll see. I mean, who knows? I hope you're right because I don't want to be right about this.
our ARC is already not doing seconds. Okay, we're doing seconds.
We never got into the second market really. We have a little bit of a HELOC program, but it hasn't. Yeah, so we didn't really get into the seconds. We're pretty much concentrating on non-QM first mortgages. That's our cup of tea.
All right. Well, okay, just of note, just because this is what we do every week, on Wednesday, we are going, that's tomorrow, just for the record, in case you don't know what day it is, which in the last few weeks, that's how I felt. I don't really know what day it is. Tomorrow, Wednesday, PPI, Producer Price Index, retail sales, mortgage applications, and the Fed's Beige Book, along with industrial production. That's a lot of news in one day, kids, so buckle up. Thursday, we have retail sales and jobless claims, and Friday, we have housing starts. Today, we had CPI, Consumer Price Index, and that came in slightly better than they were expecting, but they knew it wasn't going to be great because the replacement numbers are just rough. They were so low. So it wasn't as bad, just to summarize, it wasn't as bad as they thought it was going to be, but it wasn't great. The market does not, I don't know, the last I looked, it wasn't great. So we'll see how it goes. A lot of
Actually,
times you'll have a reaction today and then it will correct itself tomorrow, but then tomorrow we have PPI, so who knows? What, Kevin?
so the numbers I saw, it went up from 2.3 to 2.7 on inflation, am I correct?
It went from, okay, so we've got headline, that's up 0.29 month over month. So it went to 2.67. So if you round up 2.7 from 2.35, it's
That's a
up.
10% increase from last month.
It's what?
That's a 10% increase.
Okay. It's up 0.3 year over
Well,
year. And
yeah.
then core, which everyone, they love core the most. That excludes energy and food. No, not food. Yes, food. Food and energy. Good God. Okay. Anyway, that was up 0.23 month over month. They expected it to be between, 2/10 and 3/10. And it went up to 2.93 from 2.79. But again, it was expected. And what was surprising is that shelter was better. And shelter was the sticking point in all of these inflation numbers for a very, very long time. And it's 44.3% of core. So that shelter number helped because it went up 0.18. And so anyway, so that is better. It went from
Yeah,
3.8
it's
to 3.8%.
a really scary number though.
What?
It went over 3.0 or 2.99, then I think that would have spooked the market more. I know it's funny.
No, it was closer to 4 before. So used cars, new car, everything was down except for medical debt, medical care. So surprisingly not, medical was up. So I don't know how we're going to get that down. I have no good solutions for you. I also thought it was interesting to note Bill Bodner said this morning that insurance rates were up 1.1% in June, and oh, I didn't write down the other number. I think it was 4.8% year over year. So I mean, insurance is definitely an issue. Definitely. Are you seeing that?
Yes, definitely.
Yes.
An issue. We're actually having loans, unfortunately, not qualify because of increased insurance, right? Or people walking away from purchasing homes once they find out how much insurance is costing them and the overall payment, right?
Well,
So
that's because they don't have a good real estate broker, real estate agent, or real estate mortgage professional who pulls up their insurance rates before they move in or make the offer on the house.
I think
That's not the only reason. So I was hearing about the insurance rates in Louisiana from a NAM member, Ross, who is very, very, he lives in Louisiana, and he is Mr. Expert on flood insurance and really insurance in general. And there are houses in Louisiana now that have no value because the insurance rates are so high that no one can afford to insure them and live there and own them. So again, the idea that we need to ditch partisan politics and really figure out a way to fix our insurance issue across the country, as we're seeing flooding in Vermont and hailstorms in Oklahoma. And I mean, there is wildfires, everywhere west of the Rockies and occasionally in the northeast. Like it is everywhere. Forget about the hurricanes. I mean, that's a whole nother thing. Tornadoes. We have climate issues across the country that are impacting our insurance rates, and we really need to come together and figure out some different way to do this because this is not working. Would we agree?
agree.
I would agree, and this reminds me a lot of the 1980s because if you remember in the 1980s, I know Louise
Well,
does,
you, Kevin.
Audrey does, I do.
Well, you.
I know only I do for this, but I remember doing an audit of files that were owned by savings and loans, and there were all these loans in the state of Iowa where they did the math and they just said, well, we foreclosed on this property. However, the property is only worth like $7,000 and the back taxes are like $12,000, and the repair cost to bring the property to any kind of sale price is going to cost another $4,000. Our best option is to allow the county to foreclose on this property from us. And that gets to be a big problem because then it becomes the government's problem. They end up owning all these properties that are underwater and, going to cost more to fix them up than they can sell them for.
We have a comment in the chat saying that was also Detroit back in the day.
Yep.
Yeah, It is, and that is sad, especially when you have somebody in a lower income area where that's their only asset, that is their only security, is they have this house that they can live in and they know that that's secure. And now that's in jeopardy because we have this problem that no one will address because it's so partisan. So if we could all just pull it together, pull out the C word, compromise, 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 and figure out, and let's try something different. I mean,
Yeah.
what do we
But
have to lose?
we're
It's so bad now. What do we have to lose? Try something else.
yeah,
Maybe
we're
maybe it's
homes. We're in most low income homes. They're in the lowland. What happens on lowlands, it gets floods. You know,
Yeah,
just
but Kevin, we're also dealing with fixed income borrowers, right? Like, so our, our seniors, a lot of them, even if they own their home free and clear, if these insurance and taxes go through the roof, they might not be able to afford a home that they've lived in, a good 20,
correct.
30 plus years. So,
And
it's not
ways,
just the first time home buyer.
yeah, and ways are going way up too because it's same thing affected the insurance.
Yeah.
Well, the other thing too is that California, we have Prop 13, which keeps our property taxes at least in a range that you can expect what the increase will be, and it's not huge. But for those states, which I think is most of them, when you had 20 and 30% increases in values over a very short amount of time in the last few years, guess what? Those property taxes were impacted and those costs went up immediately. And again, there are a lot of people. I kept saying, what's going to happen when those people get their tax bills? And it's happening.
Yeah.
So again, this is something to maybe get in front of with your borrowers if you're in one of those places and see if there's something you can do to help them so that they're able to maintain their homes and their properties and try to help them find a solution. And to Kevin's point, having a good realtor, having a good mortgage person, having a good insurance person who has more than one option is really important. So people don't
Creating
always
a
know that.
professional team that you work with, right? That's the key to success in this industry. Consistency and creating a professional team of
Yeah,
people that you work with.
exactly. For God's sake.
Well, that just reminds me of the deal I just closed last week where the borrower was buying a fix and flip, or not a fix and flip, but a fix and rehab. And I'm like, the numbers you're telling me don't make sense. Like, I'm not seeing you being able to fix this house up for $150,000. I think the number is closer to $500,000. And I reached out to a few contractors I know, and they're like, yeah, no, they thought it was even more. They're like, it's going to be somewhere between 500,000 and $1 million to rehab this particular house.
What?
And I was the only lender he was talking to that said, you shouldn't buy this house. They were all saying, get it done. We can get it done. Right. And I'm
Yeah.
like, no, 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 you should not buy this house.
Yes.
And he ended up saying, you're the only one. So I trust you because you weren't in it for money. You were in it for me. And I trust you. And sure enough, we got him a great deal on another property. And, he's sitting pretty now.
Yeah.
Yeah. That guy wasn't grateful enough. Now I realize who you're talking about. And he should have been way more grateful than even than
He
he
could have
was.
been.
What?
We can't make them all grateful.
Yeah. They get a little, oh, never mind. Okay, so we
Yeah.
have a couple comments, collaboratives and consortiums. Am I saying that right? Consortiums. We also have another comment, insurance from Michael. Insurance, water, and power can be more than the mortgage in some states. Fixed expenses, higher percentage, only as good as your offensive line protecting you against the defense. Avoid being the scrambling quarterback. And when I first read it, I thought it said scumbag quarterback, which would also be the case. Avoid being the scumbag quarterback. So anyway, it is yeah, this idea that you push a button and you get a mortgage and that's all you need and you don't need a human and AI can handle all that and it is such again, I was talking to a guy who has or a few people who have a tech company yesterday at the conference and I really liked it because it felt like more of an integration of here's some AI, here's some tech, and here is how it works with the human, with
Right.
us.
Yep.
And they have actually, I'm going to talk to him today and see if he'd be a good person to have on the show because it was really affordable. I mean, this thing was super affordable. So, and they sell to just brokers. Like you don't have to be some big IMB who's going to buy it for 600 loan officers. You can, this just can be on a smaller scale for broker shops who need a little tech and don't have an enormous budget. So I'll be checking that out for us. But that's what I want to see is let's figure out how we make it all work together, right? That's the secret sauce, and often that gets lost in the conversation with people who think, you know what, I definitely need to be able to have my private jet at my disposal. So let's get rid of those LOs and cut the cost. Okay, so we have more inflation coming up. We'll see how that goes. We also have 30% tariffs that are currently, I mean, in the moment, who knows what will happen.
Yeah.
Uh,
So Audrey, you
for
mentioned my T words that I don't allow in my conversation. I blocked it all from my news feed. There's 3 T words: Trump tariff threats. I find them, I just block them, and then I don't get all excited because they're there, they're not there, they're not there, and I don't have to worry about it. It's
You know, but at least one of us has to be paying attention to all that so that we can talk about it on Tuesdays. I did ask an economist whether there was any way to stop listening to news and still know what's going on in the world, and the answer, he had no answer. So beginning August 1st, apparently, at the moment, we'll have 30% tariffs on Mexico and EU. Again, we are told over and over again that tariffs are a one-time hit expense and they don't impact anything. And
yes,
you know,
they have.
in their defense, I mean, those inflation numbers are not hideous. So although the tariffs haven't really taken effect, some of them have
No,
though.
they're getting canceled at the last second. It's like, oh, so why do we get all bothered about them?
So we did hear from Dr. Selma Hepp, another favorite of ours, yesterday. She's the chief economist for Cotality, and she was talking about how some of the steel, aluminum, some of those tariffs have been in effect and are in effect, and you are seeing increased costs for some of those things. So we'll see how it goes. I mean, there are people who are looking for alternatives as far as what could we do other than import it from a country that has a really high tariff. We'll see. And so, I mean, we just watch this play out and see what happens, right? Um, okay, so Louise, let's talk about non-QM for a minute. So let's start with, for anyone who is listening or knows someone who should be listening or who's in the mortgage business who isn't doing non-QM, you need to get with the program because it is becoming, I mean, I swear by the month, more and more and more relevant, important. It always has been, but if you're not doing it, you're really missing out. So, Louise, tell us about what is the most popular program in non-QM that you're seeing that is helping people, and what are you doing the most of?
Yeah, so by far nationally, our top producing product is the bank statement product. Typically, bank statement is analyzing the bank statements for cash flow and qualifying the borrower. The beauty of product like that is it allows multiple income streams. So meaning you can be W-2, but also be an Uber driver and combine income. So most borrowers in today's world, especially our first-time home buyers, but even, our refinance people or our move-up buyers, all have multiple income sources. It's rare today that you see somebody that's a W-2 person and doesn't have, a side hustle or a side gig or whatever they call it these days, right? So non-QM allows them the opportunity to use all income streams to qualify. So that's, typically a bank statement or an alt doc non-QM product. And that's our top seller for sure. And then, of course, runner up is the non-owner DSCR, and that's the debt service coverage ratio, where you're qualifying on the cash flow of the property, right? So we're taking market rents. As long as market rents and the payment are equal and or the rents are greater than the payment, you qualify. So you actually don't need a job to be able to qualify for a product like that. So 2 top sellers in the country for sure.
I've done,
Yeah, you go ahead.
I was going to say, I've done a lot of DSCR. I've got, and in particular, I have a few investors where we used to just struggle to get their numbers to work on conventional non-owner. It was so hard. And now I'm like, they're like, okay, I got my tax returns done. Can you look at them? I'm like, I don't care. I just don't care anymore. So the only sticking point with a lot of investors is, are you planning to ever live in the property or have a relative live in the property? If the answer is no, price it out. I always compare it, price it to conventional versus DS or non-QM. But for me, and I've got good borrowers, like 750 plus FICOs. They all have good jobs, good income, good assets, and it's almost always better for them to go non-QM.
It is. the pricing alone, I mean, it's right in the market. If not, sometimes non-QM pricing is actually better.
Yes.
And I think that's really what shocks people in today's
Yeah.
world, right? Is that they're thinking that non-QM is going to be in the 9, 10, a plus rate. No, we're in we're in the 6s and 7s, guys. So
Yep.
definitely, take a look at non-QM. If you're not doing non-QM in today's environment, I don't know how you're surviving in this industry, to be honest, right? I mean, you truly need your toolbox, right? We're talking about having a professional team and working with different realtors, insurance, professional loan officers. It's the same with your lenders, right? You want a good wholesale lender that you can count on to help you understand a product, sell a product, right? And really have that arsenal of a team behind you to offer your borrower, once again, the best thing that's good for them, right? What products do they need? What type of loan do they need? So absolutely.
And then because self-employed people either. I did one where it was a divorcing couple, and the wife had not been working for the last 8 years or so had to get back in the workforce, had gotten back in the workforce, but was not making the kind of money she was making previously to leaving the workforce. And she was trying to figure out how to qualify for, a loan now to keep the house. And what I realized was that, well, she's also getting a $500,000 in the settlement. And I used the depletion of the $500,000 as part of the calculation using DSCR. And being Mango, she qualified for a loan when everyone else she talked to said, oh, no, you don't qualify.
Right. And that's what I'm talking about, multiple income sources, right? So you can do asset depletion with W-2, with bank statement, all in one loan, right? You can combine all those income sources. So once again, if you're up to speed on the non-QM rules and guidelines, you'll be able to, get that person into a loan that otherwise everybody else would say, well, no, you don't qualify. But to your point, $500,000, yeah, you divide that by 60 months. That's good income that you can use to help qualify, in addition to her going back to work and potentially maybe some alimony or whatever her judgment said that, she was able to get. So, all those combined probably saved her home, right?
Yep, absolutely.
It's incredible the options. I talk about this all the time because often you hear somebody meets you and they're like, their first question is, what's the rate? And their first question should be, what kind of mortgage strategy could be used for you to get me a loan? And they have been so brainwashed. The whole industry is brainwashed into thinking that our only way forward is if rates come down. And just a little reminder that just because maybe they lower the Fed funds rate, that is not going to tell us that mortgage rates are coming down. You get some crap inflation number, you get some job number that we know is bullshit, but still is going to impact the market. You get a country invading another country, whatever. Someone could sneeze hard, and all of a sudden, nobody cares about the Fed funds rate, and their mortgage rates go up. And so again, focusing on what is available today, how do we use strategy and different all these amazing programs that we have now that we never had before. So we have so many opportunities to help people, but boy, we got to do a shift in this narrative about these rates, and it is pervasive. If you looked at all the leaders on LinkedIn in the mortgage space, the ones that have nothing but time to go on and wax poetic about how we need to do this or that or get rid of this person or change this or the rates have to come down, I'm like, no, talk about how people get loans. How do people get mortgages? How do you fit people? And this affordability thing, I know that I have talked about this before, so just bear with me. But again, okay, our loans is it less affordable now, or do you just have a different lifestyle than people used to? So, I mean, I remember when I was a kid, we hardly ever went out to dinner, ever. Even when we went somewhere, we'd pack a lunch or we'd take something with us, right? It was a rare occasion. And now we just eat out, all the time.
I was talking to someone yesterday and that they ate out every night.
Yes.
Every night. Like, wow, that's an expense. I'd like to see that bill.
Right.
Yeah, and across the country, eating out, it doesn't matter where you live, it's expensive everywhere, right? I mean, as we are all right now on the road traveling for the convention, right? I travel all the time for different conventions and events and working with different clients. And I mean, whether I'm in Nevada, Arizona, Colorado, California, right? Florida, Texas, New Jersey, it's expensive everywhere. So,
hey, getting back to getting rid of like certain people, like the Fed chair, people don't realize that the Fed chair is of a board of 12 governors, and all 12 governors have to vote on a move in rates, and you have to have a majority. Most of the time, it's a super majority. Like it's usually it's unanimous, but once in a while, one or two board members will go the opposite way. But never, you don't ever see like a split vote of 7-5. It's 10-2, 11-1, or 12-0 most cases. You get rid of Powell, you don't get rid of the board chairs. Now, I don't know if maybe they're planning making across the board, but and people are like, I think the market will react completely the opposite. I think if they got rid of Powell, that would scare the market so much that you would see increases in interest rates, not decreases in interest rates.
Nothing the market likes more than uncertainty. Come on.
Yeah.
Right?
Oh, yeah.
It's just
That's a little uncertainty in the world. Come on.
so apparently, they're going to open an investigation into Powell. I mean, at this
Oh yeah, the building thing. So I talked about this last week. I did a little in-depth analysis of that building project that went from I think it was 2.7 million or 2.9, or no, 1.9 to 2.4 or something like that, in $1 billion project. This building is the entire block in Washington, D.C. It is not a small little building. $1 billion, if you do the math, like, oh, wait, those numbers kind of make sense. And it only went up by what, 10% from the 2019 estimate to the 2024 estimate. I'm pretty sure we had 20% appreciation somewhere along the road there. And so the numbers didn't go up by 20%, they only went up by 10. So
right about that. I mean, if that's true, if the number by 10%, do I think it's reasonable to have $1 billion Fed building? No. But my suggestion was we should have just moved
2 billion, 2 billion.
the CFPB building that also cost $8 quadrillion, whatever that was. Anyway, I think that's crazy.
That building's not as big and it's not as historical.
Whatever.
Yeah, the Fed building is actually quite historical. I think it's even on some currencies, if I seem to recall right.
But you are correct in, if it only went up 10%, that is less than the
Be fired. Just we have to fire him.
I don't know. I just think on both sides, I just don't like this. Where you're burning everyone at the stake every time there's a change. And again, this is me in the middle saying, okay, people stop it. Like this is just cray cray. Cray cray. That's a technical mortgage term. So Peter said our regulators and government aligned all disclosures around rate. It's the only thing the consumer has been told to compare. And he is right. And how many times did I slap Mark McCardle around for the CFPB over that subject where I was just giving him crap about how, okay, rate is not it. Rate is a small part of this process. The bigger thing is, did I just spend 3 years helping you get your credit score whipped into shape so that you can actually qualify for anything? Did I give you a disclosure that was truthful and honest? Or did I give you some pile of garbage that I'll change at the last minute? Or are you 86 years old and I'm charging you 3 3/8 points on a mortgage that you will not ever be in the property long enough to,
Receive benefit. Yes, we saw that.
God, so many things. Okay, so Guy says long live e-loans, no human, no service either. And he also made the comment that Louise Woods made a deal with the devil because she never ages. So
thanks, Guy. But I did not make a deal with the devil, I promise.
so and we have people agreeing with you, Kevin, about changing the
No, that's not possible.
well, you know what? Miracles do occur, and here we
People
are.
are agreeing with Kevin.
Calendar today, kids. It happened. So, I mean, again, I think what bothers me is, okay, do we know what's going to happen if they A plus B? Do we know it's going to equal C, or do we not know? And I think at this point, there's so many moving parts to everything that this idea that, oh, if you just remove this one person, replace this person, change this one thing, it's going to fix everything. And I just think that is a pipe dream, just based on the complexities of what we do and how the market comes together and how things are priced and what the market responds to or doesn't respond to. So Okay, in other news, because this was really something, a bill has been introduced. I want to be clear, it has not been passed, it has not been vetted, but it has been introduced in Congress. I'm not even going to say by who because I can't. But it to eliminate the capital gains on primary residences. So I don't know if we'll get away with getting rid of the capital gains, but if we could just, at least that would start the conversation to raise the amounts of capital gains exemptions on primary residence, that would be really
That
fantastic.
be so huge because a lot of people are locked into their houses. I can't tell you how many times I get a math of, well, we own this big house, it's 5 bedrooms, 3 baths, and it's just my wife and I now, and the kids they're not coming back anymore. Really, we could go by with a 3-2 or a 2-1. But when we do the math, like the capital gains we'd have to pay, and then we end up with a smaller house with a higher interest rate, therefore the monthly payments are higher
Okay.
and the taxes are higher, and it just goes down this thing. It's like, wait, it's cheaper for us to stay in the big house, and that doesn't help the housing market because you need people moving from house to house to have, because we need people to move up. So people in their 3-2s can't find a 5-4 or 5-3 because there's two seniors sitting in that house because they can't afford to leave it. We need them able to move along so we can move people up to the next house, and then that will really help the housing market.
Yeah,
Yeah.
I mean, our overall lack of inventory, right, is our problem in
Yep.
today's world for housing. So yeah, and that definitely would help with that problem.
And despite all the inventory conversations and the fact that inventory has increased this year quite a bit, the last I looked, and I think it was a week ago, even though we were up, we are still down 13% from pre-pandemic. And that is a national average. Just to be clear, again, we've seen charts which break down the inventory levels by region or by state, et cetera. So make sure you're looking in your area to see where you are. But the other thing I'm seeing too with properties is a lot of the properties are not being priced correctly to begin with because you have a real disconnect between buyers and sellers. So the buyers think it's a buyer's market, and in a lot of cases they're right, but they think that it's a fire sale, that everyone's desperate, that there are no buyers, and that they can do whatever they want. Conversely, you have sellers who want a certain price, they believe that they should get that price, and a lot of times they'll talk a realtor into pricing a place higher than it should be. And that's a mistake because then you have these price reductions, or I've heard that or read that the number of delistings of properties being listed and taken off the market is really high in a lot of areas. So again, someone will put it on the market, they don't get the price they want, or you get some ding-a-ling that I was talking about like a month or so ago, where you've got a realtor who set a place on the market for 2 months. They announce that they only take offers Monday through Friday from 9 to 5, and that they are using transparent pricing, yet when an offer is presented at the list price, they don't take it, indicating they want an extra 250. That'd be not $2.50, kids, not $250. No, they want an extra $250,000 around transparent pricing, which caused me to question whether I actually knew what transparent pricing was. Turns out I did. They didn't. Oh my God.
No,
So
that's not.
dumb things out in the market. Like, people, educate yourselves. Geez Louise.
I didn't do it.
You're innocent, Louise. That's why I've been, yeah. Okay, so in other news, medical debt. Remember that? Remember when medical debt was removed from all the credit reports and that was going to change everything and help everyone? Like 15 million Americans, $50 billion in medical debt. Yeah, well, a federal judge in Texas reversed that rule permitting medical debt to be wiped off of the credit reports, said the CFPB exceeded its authority. That rule was finalized in January, and so now we'll see what happens with that. You heard anything about that, Louise?
No, I have not. I mean, we're still, kind of looking at medical debt as kind of it's an expense, but it's not a concern. I mean, but as you're stating, I mean, we're hearing that more and more Americans today are in debt over, just regular medical care. We're not even talking, heart attacks and major hospitalizations. We're talking just everyday medical care that people are in debt. So it is again, another expense that we have to factor into, living a day-to-day life here. So
Well, if it wasn't on the credit report, you wouldn't see it and you wouldn't be considering
that
it.
is true. Absolutely.
Way, huh?
Wait,
Yeah,
this makes right. So I have to pay these bills that I've been getting that I've been ignoring now?
you are supposed to pay them, yes.
We'll have a private meeting afterwards, you, me, and Louise, Kevin, and we'll school you on paying your bills.
Oh,
So, um,
just
yeah,
want to be clear. I thought there was some I didn't have to pay.
yeah. Okay, so also we had FHFA Pulte come out and say that we are going to now take Vantage scores in on credit reports for conventional GSE loans. Louise, are you taking Vantage scores?
We are not. Again, we're a non-QM lender. So, we don't run our loans through DU. We're still manually underwriting our loans, right? You got to remember, non-QM loans are creative solutions for borrowers. So we're manually underwriting those. We're, again, using multiple income sources, different, ways to qualify, whether it be a cash flow loan or actual income. So yeah, we're still 100% manually underwriting these loans and using the good old fashioned regular credit score system. Does that mean we won't?
Right.
Not necessarily. It just, we haven't adopted that yet.
Yeah, the biggest thing to me with the Vantage is the scores system is completely different. It's kind of
Yeah.
like centigrade and Fahrenheit. Oh, well, it's 0 degrees centigrade. Well, oh, wait, that's 30 degrees Fahrenheit. I have a better score. I'm like, no, yours the same temperature. You just use a different gauge. So,
Okay, so just for the in the interest of, me and the facts, so these were some of the things that are supposedly changes. So it's an alternate, they use alternative data like rent, utility, and telecommunication bills that you can put on there. But I just would like to point out that you're also able to add those to a regular credit report. So
and bad idea.
it says eliminates requirement for consumer file to be more than 6 months old. So that could be something. Estimated helps up to 5 million new buyers. Here's the thing. I heard again, like a top person in the profession that everybody lives and dies and breathes by what they say. And they're like, oh, it's going to save people money and it's going to this. No, it's not because they're, first of all, let's just recap. They're owned by the credit bureaus. Vantage Score is owned by the credit bureaus. So, and their prices, they started off low and went up 400% in 1 year. So they are right in line with what the cost is for FICO, which again, I don't have anything against Vantage Score. I'm just like, okay, is this going to really help? I mean, as people are going to have expense around integrating this into their systems and figuring out, and again, there's nothing that says that we only need two bureaus now instead of three. Like, there's nothing that's going to cut the cost of this whole thing. So we'll see if this ends up being a win or not. So stand by, but it's out there. Yeah. Louise, let's talk about doing loans in other states. So we've talked on here a number of times about the fact that for certain business purpose loans, you don't have to have a license in certain states. So again, we're not going to go through that list because we want everyone to figure that out for themselves and not say, Audrey told me to, and it was fine, and then it wasn't. So there are states that you
That's
don't.
what I did, though.
What?
That's what I did the other day.
Yeah, I know. Okay, Louise.
So yeah, if you're doing a DSCR loan, and let's just say for whatever reason you're licensed in California and you would like to do a DSCR loan in Texas, and you're not licensed in Texas, under the business purpose rule for non-QM, you are allowed to do DSCR loans in states in which you are not licensed. There are certain state rules, of course, each state is a little bit different. There is a list. The ARC website has it for you. So archome.com, archome.com, super easy. And you can go there and look up the guideline and look up the state list and see, if you want to branch out and work in, other states for DSCR. But you are correct. You're not required to be licensed in many, many states in the nation if you're doing DSCR loans.
And just make sure that if you are going to do a loan in another state, at least do a dive into what the differences might be between where you're licensed and what you're about to do, the rules where you are about to do a loan, so that you're tail handed to you on a silver platter and then
All sorts of traps there for you. So, like New York, they have a 1% refinance tax. So, yeah, you don't want to get caught. Oh, yeah, and then the closing costs for this and this. Oh, no, you failed to disclose the New York tax. Like, that's a significant number sometimes that could make or break a deal. In Texas, it's very difficult to do an equity line or second loan on a property. They really should discourage it. And that's because Texas has a lot of boom and bust, and because they're mostly oil industry, or that's their biggest economy is oil. And the oil industry has its booms and a busts, and they don't want people losing their homes because they took out an equity line and then there's a bust, and now they can't make the payments on that second loan, and now they lose the house.
Yeah, even prepay penalties, right, on non-owner loans, because a lot of the DSCR loans, you'll put a prepay on them, maybe just a year upwards to 3. Different states have different rules for prepayment penalties, even on non-owner loans. So every state has different rules. Once again, this is going back to team up with a professional that you can trust and you can count on giving you the correct information, helping you structure deals, helping you enter into maybe a new market. That's what we do, right? We educate. That's our job, is to educate all the loan officers and producers out there, on different types of products to help their borrowers. So,
the other one I ran into the other day, which was a really weird one, was Washington State requires that the loan officer for the customer in another state be licensed in Washington. So if you're a Washington State resident and you're buying a property in California, you're required to be licensed in Washington also.
Yeah.
Kind of crazy. I don't know how a state can actually get away with that, but
I thought it was okay. I thought it was the opposite, but I'm going to take your word for it since you're actually licensed in Washington. So let's assume you're right. But without anything you hear on here, double check that shit with your
stuff. Yeah, we're not attorneys. We don't even play them on TV.
God. Oh my gosh.
My name is Elle Woods, but I am definitely not an attorney.
Okay, so I was talking to someone yesterday, a non-QM lender, and they said they're at the end of the month expanding their LTVs on DSCR properties, which I thought was interesting, as we are in this market that's really very interesting, in my opinion. We have all this uncertainty. We have buyers and sellers who both think that they should be in the driver's seat. Nobody really knows which end is up, and some people are expecting for some big, humongous bust. Most others think that isn't coming. Like, all this stuff is going on. So I wondered, are the guidelines going to be expanding, contracting? Like, what do we have to look forward to hear the LTVs on a DSCR would be expanding was really interesting. I'm going to not say interesting again. I was blown away, actually. So
what you have to look at is the defaults in the non-QM space, right? In the securitization market are still extremely low, right? The majority of these borrowers have equity in their homes. Whether they're purchasing, they're typically putting 20% down, maybe as little as 10 in certain situations, but they are putting, a decent down payment. Once again, they have multiple income sources, so they're usually well qualified, right? We are manually underwriting, so we're analyzing the overall cash flow of these borrowers. So what the ATR, the ability to repay, is absolutely there. So the risk on these loans is very low. So yeah, we have these conversations all the time with our credit risk team as to how can we expand the credit box, right? How can we offer more options, higher LTVs, higher loan amounts, less reserves, or just, more opportunity in the market. So it is a regular discussion, and most non-QM lenders will tell you, they're probably meeting with their credit team at least every 30 days to say, what can we do better? How can we expand the credit box? Anybody that does regular non-QM business knows that a very large portion of our overall business is exceptions, right? So, hey, if you happen to have, 12 months reserves in the bank for your particular loan, are we going to maybe, look the other way on, a little guideline that doesn't quite fit, because it makes sense that this borrower, right, will qualify for that home and has the reserves to back it up. So the common sense underwriting, back in the day that we used to always say, that's a very non-QM mentality. So yes, we are always looking at how to expand the credit box and how to increase the amount of exceptions that we do in the non-QM space.
I would love to hear that the GSEs are doing the same. That's what I'd like to see the focus be, is let's work on things that are really going to help the borrower. Let's take a really close look at those LLPAs, which are crazy in my opinion. And then look at the guidelines that no longer fit incomes, job types, the fact that people have multiple jobs, the fact that, okay, we can't look 3 years into the future and know someone's going to be employed. I mean, you can fire someone in California for no reason. they could have a job today and it's gone tomorrow. So to expect that you're going to show the income is going to, continue forever, that's nonsense. I mean, it's just, so I'd love to see the GSEs follow suit, but in the meantime, thank God for non-QM. I mean,
Absolutely.
God. So I just think we're so lucky. All we have to do is take advantage of it and then find our borrowers and help re-educate the public. That's it. That's all we have to do. Change the narrative in the mainstream media, educate our borrowers, and change the way people think about how they get a loan and what they should ask first.
Simple. Love it.
Oh my God, so funny. Anyway, but I love hearing that you guys are connecting every 30 days to have these conversations, that you are looking at things like, okay, in my mind, the bottom line should be, can they pay the money back? Will they pay the money back? And we lost sight of that as soon as the secondary market opened up and they started selling everything, and then everything had to fit in this little tiny box where you just checked off different things. Okay, we did that, now we're good, we can sell it. And so going back to, and I know you guys securitize your loans too, but having that flexibility, but still being able to sell them on the secondary market, that tells something to the conventional market, which is, you can do this. This
Right.
is possible. Why they aren't, anybody's guess. Although I'm sure we'll have some listeners who will take some guesses. So let me have it, guys. Tell us how that works. So anyway, so things that are coming down the pike for you guys as far as what you are looking to do as far as expanding your credit box or loan product type. You had mentioned that you might be working on fix and flips.
We've definitely discussed it. It's part of our product expansion of what do we want to do. We definitely are looking into the 5 to 8 unit space, and then we're also looking into a fix and flip type loan. Many of our borrowers, once again, need to fix homes. So, are we looking at that as an owner occupied fixer type loan, or are we looking at a fix and flip where we're allowing investors to go into markets, fix up properties to get them on the market for people to buy, and that would help our inventory, right, overall. So those are things that we're looking at adding potentially by the end of the year, if not into next year. As crazy as that sounds, will be in 2026 before we all know it, people. So it doesn't, when I say it out loud, it sounds weird, but it'll be here before we know it. So those are discussions that we're having. We have a vested interest, just like all of you, right, of adding more home buyers to the market, right? We want to educate, we want to be able to offer products that increase inventory in certain markets, that help first-time home buyers, that help move up buyers, as Kevin was talking about. So all of those things we have those discussions about, and what products will help the industry in an overall. So yeah, those are the two that we've been talking about probably the most.
So when you say you're going into 5 and 8s, are you saying for DSCRs or for fix and flips?
It would be for a cash flow loan, yeah, something like a DSCR.
And what about ever going to 8 to 10?
I never will say never, because as we know, the things change in our industry constantly, and that is a marketplace that is doing well, right? I mean,
Yeah.
people are in that market. So it has not been on the topic of the conversations I've been a part of most recently. The 5 to 8 market seems to be kind of
That's the most popular one, but there are a few lenders that do the 9 and 10 unit buildings.
absolutely.
But why there's this grade, and then why no one goes over 10? Is it just considered too commercial?
I think that gets into kind of a different area of property type,
Yeah.
right?
I've been pushing the DSCR loans, and I basically just push, hey, it's a 30-year fixed.
It is.
What you can't go to a bank and get a 30-year fix on a apartment building. You just can't.
Right.
So, hey, why do you have to renew your loan every 5 years with the bank and have to pay them points and do this all over again and worry about rates going up on you when you could just get a 30-year fix and be done, and the rates aren't that bad?
No, they are not. Absolutely.
And you can sometimes, sorry to brain twitch there. Did you hear that happen? Sometimes you don't even have to have a cash flow on a property. Some of the DSCR loans, you can have negative cash flow and still qualify. So it's all just, it's old school. Call
Yeah.
around reps, have a good rep. Louise has good reps, and people are asking for your contact information. They can't see the chat. So tell them your email address, Louise.
It's super easy. It's lwoods@archome, archome.com.
Yes, Louise Wood. She's the regional for ARC. So she will point you in the direction that you need to go in. So there have been announcements about FHA, FHFA, like appraisal policies being rescinded that had been put into place related to a number of different issues. And so their point is they're trying to cut the red tape and make it a little easier. So just be aware of some of those changes, and if people are interested, maybe get someone on to talk about them. But yeah, that's been happening too. Making it a little easier, maybe. I don't know. We'll see. I mean, and again, as far as delinquencies go, that conversation continues, in my opinion, to be interesting because the GSEs, non-QM, those are performing well still. And even though the delinquencies are up a little bit, it's negligible and they're still, I mean, performing really well. It's the Jenny loans that are having some issues, FHA and VA. And so just, you know, just be in touch with your borrowers, especially people who've bought in the last couple of years. If somebody loses a job and they did an FHA loan a year ago and they don't have the equity to pay real estate commissions, et cetera, those are the people who are going to need some special attention, and maybe you could be of value. Another thing to know is we have all received at this point notices from NMLS stating that we have to renew our, re-up our continuing ed, take your 8 hours for the year, so that we are prepared to renew our licenses come November or whatever it is. Is it always? Yeah, I always think it's some different day, but it's the first. So anyway, don't be alarmed when you get your notice saying make sure that you are taking your continuing ed.
No, only a couple people got those messages. Not every.
Really, just me?
Yeah.
Targeted? Is that what's happening here?
Targeted, yeah. I don't think all the loan officers got those messages.
But maybe they didn't send one to you because they know you're not going to listen to them anyway. So anyway, so we have a whole slew of classes that Kevin and I will be teaching this year. So
Live in person.
Live and in person. We are also like we have one in August that's online, but live, also live. The feedback we receive every single year is the automated continuing ed is a nightmare. It takes 10,000 times longer than it should. And that people a lot of people are shifting back to going to take their NMLS in person because it goes faster. There's community. It's a more interesting conversation. You don't have to sit and stare at your camera all day long, hoping to God it doesn't decide that you weren't paying attention enough and boots you out and takes away your credit. So,
or you don't have to worry about blowing your brain out because you have an AI speaking to you in a robotic voice.
So what was that? You were renewing one of the states that you're licensed in, right?
Yeah, and I had to take one of those things, and for 2 hours I had to listen to this AI talking, and I literally wanted to just, kill myself. It was so torturous. And I mean, literally it would read the code numbers of the bill that passed. It was like, according to AB 473-217.69, you can, and it was just like the whole time you're like, I'm not learning anything from this. I just want it over. So
I mean, and a lot of people approach it like that anyway, but it is.
I mean, what people really do. What they do is they turn down the sound, they wait for the test, they pass the test, and move on to the next section.
That's typically what most people do. I would agree with you, Kevin. So, but yeah, I mean, you guys
learn
classes in person. Everybody needs to get out there and let's see each other again, right? I mean,
absolutely, yeah.
We over people. It's time to get out and shake hands and say hi to people and hang out with your peers. You learn something every time. Every time you see somebody, every time you hit a convention, every time I get in the field and go to offices, I learn something new. I connect with people I haven't seen in a long time. I meet new people. It's good. It's good for us to be out and about in person.
Yeah. I got new loan programs just from yesterday going to the different vendor booths. It's great.
Right? Yeah.
Yeah. So good. Anyway,
we're way over time.
I know. Thank you, Louise, for helping this go very, very quickly. We really love you, and it's always fun to have you on. And we'll look forward to seeing you at lunch.
Yes, for sure. Thank you for having me as always. I appreciate you guys.
Yeah, we love you. to everyone else, we love you too. Go get a loan this week, close it. They're out there. Don't wait for the rates to come down. And then tell us what's going right for you. Tell us what's good. Tell us what you need to know. We'd love to hear from you. So, with all that being said, kisses. Have a great week.